Hey, welcome back, options traders. Happy Friday, everyone, and I hope everyone's looking forward to a great weekend. And this is the final video in a three-part series that started off from a question from one of the traders in the group asking about these gut iron condors. So we talked a little bit about the various types of condors, then we answered the question whether they provide an edge or not. And so now we're going to actually get down to the question, and that is why use gut iron condors? So let's go find out. And as always, before we do, please be sure to click like and subscribe. Definitely helps to promote the channel and is greatly appreciated. So remember about the condors. They require 4 different strikes. They're going to be in this type of a format: long an option, short 2 in the center, long 1 at a higher strike. So we usually call it long the wings. Those are the numbers in green. And we're short the center, or what's called the body. Now, they also have to have the same expirations, and for your standard condors will be equally spaced, meaning that we're going to go from, let's say, the 100 to the 105, 110, and so on. So with the condors, there's different categories. Remember that a standard condor is created with either all calls or all puts, no mixtures, and it will always be a debit. Then we get into the short iron condors, which will have exactly the same profile, but these are a mixture of calls and puts, and they will be a credit. Now with the short irons, we're going to have the put strikes on the low side, and the call strikes will be on the high side. And finally, we get to the gut irons, which are a mixture of calls and puts, just like the short iron, but they're a debit. And here we're going to reverse these strikes. The put strikes will be on the high side of our graph, or to the right, whereas the call strikes will be to the left. But no matter which one of these we use, take your pick, standard condor, short iron, or a gut iron, we are going to get this basic shape. Now, the reason I say this basic shape is that the distance between these strikes depends on the strikes that you're using. But it will definitely have this basic shape. Looks a little bit like a butterfly, but this top will be flattened because of the 2 different strike prices we're using. So we can see that it has limited risk, limited reward. Over here, our maximum loss is $2 on the left wing. Maximum gain here is 3. And over on the right wing is also a max loss of 2. If we have these strikes equally spaced, the max loss on the left and right hand sides will be the same. So that's our expiration graph. Today, let's say with 30 days to expiration, we're going to look like this one in blue. As time passes, this center part is going to rise. This is what we'd ideally like to have happen. Normally, when you put these positions on, you're going to enter them with the stock somewhere here in the center. And so as time passes, these wings will start to drop. You're going to be in negative theta in those zones, and we'll lose money if the stock is out here. So watch what happens. Let's advance the clock, let's say 5 days, 25 days to go. And we can see the center has lifted up, and the wings are starting to sink down a little bit. Let's jump to 20 days to expiration, just exaggerates that same movement even more. 15 days, 10 days, 5 days. Look at the jump between the blue and the orange line. So yes, you do get bigger gains as you get closer to expiration. However, you've got to be really careful, especially if you're new to these condors. And do you see how much curvature there is? Looks like an upside down letter U. That's negative gamma. The more bend that there is, the more gamma there is. So this is showing that if the stock makes an upward move, look at how rapidly you're going to move into losses. Same thing if it makes a downward move. So you don't get that effect down here on the blue line. It's fairly flat. And this is why it might take you 4 or 5 weeks to build up a certain profit and 1 or 2 days to lose it all. So another basic rule, when you are trading these condors, I would probably take about the halfway point here. So if our maximum gain is 3, I would probably look to exit at about $1.50, $2. Otherwise, you better be willing to pay the price for having severe negative gamma. It can really come back to haunt you. So again, regardless of which type of condor that you choose, it will have the same basic shape and these characteristics. But a lot of times you're going to hear that traders are going to tout one type of condor over another because of some special property, that it doesn't decay as fast or other kinds of crazy things you're going to hear. So let's also go to an Excel spreadsheet and take a look at 4 different types of condors. I'm going to put each one separately into a pricing model, and let's see how big of a difference we get. Okay, so here's an Excel spreadsheet, and I've got the stock at 107.50, which is right between our strikes. We're going to look at the 100, 105, 110, 115 condor. That's the basic model that I've been using throughout these videos. So I've gone through a pricing model and I've put in the prices for all 4 basic condors. We're going to look at one with all calls, another using all puts. We'll look at the iron condor with the puts on the low side. Then we'll look at the gut iron with the puts on the high side. So take a look at what we have here. Let's start with this first one with all calls. So do you see this graph in black? That's what we look like today with 30 days to expiration. Now, what would happen if we created it with all puts? Now, I want you to watch this black line very closely as I move this over, and look at that. You can't even see it move because it's exactly the same thing. So we don't choose the calls or the puts because of some special property. They're exactly the same. What if we do an iron condor, the credit spread? Watch closely. And there we go. Now you might have noticed it shifted down ever so slightly. Watch this. It'll shift up ever so slightly and then down. We can also see it over here. Take a look at some of these numbers. For example, here's 1.997 and then 2.007. We are talking fractions of a penny difference. And there are reasons for it. I'm not going to go in why it is, but it just doesn't matter. This is not going to be a reason to pick one over another. Now, let's take a look at the last one at our gut iron. Watch closely. And there we go, exactly the same. So we don't choose one of these because of some type of a magical property that you're going to hear people talk about. If they mention these special properties, they are misperceptions or possibly deceptions to try to get you to buy some type of a training course or their stock picks. But they are all exactly the same. This also follows from just basic options pricing. It has to be arbitrage free. And so if they have the same payoffs and the same shapes, they can't have radically different characteristics in between. Otherwise, it would create a situation for free money. So the reason that we pick one over another is not because it decays faster or slower or has more rewards and less risk and other things that you're going to hear. For any given expiration and strikes, they are going to behave reasonably close to exactly the same. All right, so why would we choose one over another? All right, well, there's a couple of basic reasons, at least the ones that I want to cover here. By far and away, the number one reason is the ease of the morph. Remember what a morph is? It's where we're going to add or subtract a leg to alter the risk-reward ratio. It's either because the position is moving for us or maybe moving against us. Maybe we wish to lock in some profits but stay in the position. Those are all types of morphs. So let's look at the standard call condor. One reason for using this is, let's say that my chart looks like it might be bumping up against resistance. And I think, well, there's a good chance it's going to bump up against there and then retreat. But if it breaks through and we have this really serious breakout, I might not want to have a neutral strategy. And so if I think that this breakout might occur to the upside, I might want to create it with all calls. Because if that happens, all I have to do is close one position out. Now I've got a bull spread on the left, and I have a long call free and clear over here on the right. So just by closing that one, we move from this black line to this. This is a morph. Here's my vertical spread right there. And then over here is the long call, the long 115 call. So with a very simple trade, the closing of the 110, I now have unlimited potential gains. Now, of course, if we thought that the reverse were true, something might break down to the downside here, we might choose to construct it with puts. But this is a very basic reason for using the all call version. It gives us a very easy morph on a breakout to the upside. Now, what about the short iron condor? Now take a look with this. Notice we have puts on the left, we have calls on the right. We have a mixture. So if the stock breaks out to the upside, I can just close out this 110 call. I've got my bull spread on the left. I have a 115 call free and clear over here on the right. What if it breaks out to the downside? See, now I have an easier morph to the downside. I don't have that with the all call version. I would have it with the all put version, but now I don't really know. I'm banking that it's going to be to the upside with the calls, or banking that it will be to the downside with the puts. But when I have the short iron, I get both. So if the stock breaks down, now I just close this one out, and I have a bear spread with a long put that can capture those unlimited downside gains. So this is one of the big reasons that a lot of traders will choose a short iron condor. It is for the ease of the morph. If the stock happens to break out in either direction, it is not because it's a credit. Remember, when you execute the trade, it will ultimately be a debit. So we choose one of these over another for other reasons. So this is a very good reason for choosing a short iron condor. Now, what about the gut iron? So now we've got the calls on the left and the puts on the right. We've got this boxed in position that I talked about in the last video. But look what happens if the stock breaks out to the upside and I close this short strike out. I now have a bull spread. Okay, well, it's limited to the upside. But see, now I've got a long put. So that really kind of handcuffs you. I can't capture these unlimited gains at least as easily when I have a gut iron. And of course, I have the opposite problem to the downside. If I close out this call, yeah, I've got a bear spread, but then I've got a long call coupled with it that's just going to get annihilated if that stock in fact falls. So you really can't do a play for a breakout. But what we can do, there's a number of cool things we can do, is to recognize that these are two vertical spreads, which is true in all cases. But here's our bull spread. And if the stock is out here somewhere, I can close this one because it will be trading for roughly maximum value. And I can close that and just hold the bear spread, but at least I have limited risk. See, that's not true when I break it apart and I've got that wide open call or wide open put. It might look like we're right. We might have actually paid a lot of money for it. The stock whipsaws and we end up potentially losing a lot more money than we initially anticipated. But see, that's not going to happen here because we always maintain a vertical spread. So if we think it's going to be to the downside, what happens? We've got our bear spread over here. We can close this one out because when the stock is down here, this will be trading close to maximum value. So I would just close this and hold this one maybe as the lottery ticket. And now I've got this maybe an at the money call or slightly out of the money call. Lots of good gamma here to pick up if the stock in fact rebounds. So these can also be very good for playing high volatility types of stocks. Now, what's reason number two? The second reason is for skews. Skews are mispricings that occur in the markets, and as a basic rule, you want to buy the low implied volatility and sell the high implied volatility. But in today's markets, these are becoming few and far between. I can tell you that, especially if you're paying any kind of commissions at all, and after bid-ask spreads, any type of mispricing in terms of volatility is probably going to be completely wiped out. Now, 10 or 15 years ago, that was not true. But now with all of the alga bots and everything out there, these prices are really, really efficient. So what are the skews? Well, we've talked about this before. Remember, let's say that this is 20% volatility maybe, and maybe that's where the historic stock price has been. Well, theoretically, all of these should be trading at 20% volatility. So let's take a look at maybe the November options. I'm going to put the puts on the left and the calls on the right. So these will be out of the money calls. These will be the out of the money puts. Stock is trading right here at 100. So if the historic volatility was 20%, we would expect each of these strikes to be trading at 20%. But in the real world, we're going to find that that rarely happens. We're going to get something like this. We will see that the at-the-money strike will trade very close to the historic implied volatility. There's an arbitrage if that's not true. but we usually get a very big bump to the upside up here in implied volatilities for the puts, and we will get one usually not quite this pronounced, but for the calls. So here we've got 15 points down, we've got this implied volatility. 15 points up on the calls would probably be down here somewhere. But I just kind of did this to make it easier to understand what a skew is. Theoretically, we should be on this red line where all of the strikes are trading at the same volatilities, but they just don't. We get this. And so when this happens, now we might choose one type of condor over another because I might be selling this put or I might be selling this call. And depending on what we think is happening or might be happening, we may choose one type of condor over another. But once again, I would really pretty much cross this one off the list as a good reason for choosing one of the condors over another. However, there is a reason related to this idea of skews that might give us a reason for choosing one condor over another. And that is the at the money, as I mentioned before, will usually trade very close to the historic volatility of the stock. So maybe we buy this one because it's relatively low, and we sell this one because it's relatively high. That's the basic recipe. But if the stock in fact falls, these relative positions are going to switch. This one will now be the out of the money, this will be the at the money, so that curve effectively shifts here. So now this one that was the high implied volatility falls, and the one that was low actually rises. So if we're long this one and short this one, that's actually a boon to us. That actually becomes an added benefit. So depending on what might be happening with changes in the stock's price and implied volatilities, could be a reason for selecting one of the condors over another. The gut iron condor will also give you a little bit more freedom from changes in implied volatility because your short strikes are in the money. And so they're not going to have as much extrinsic value, which is the part that gets bumped up from implied volatilities, which would be a negative for those short positions. So by using the gut iron condor, those center strikes are in the money, and so they're not as susceptible to changes in volatilities. But I hope that gives you at least a basic idea of the reasons that we might choose one over another. But if you get nothing else from this video, please make sure that you understand when you're seeing these videos out there on YouTube where traders are trying to convince you to use the fanciest sounding one because it provides some kind of a benefit that is not found in the others. The main reason for doing one over another is because of the ease of the morph. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.